Hi, here's a new episode in Web Intelligency's I-based podcast. We are Mark and Rita.
And today we're doing a really crucial deep dive. We're looking at the Israeli startup scene.
Yeah, what's happening right now, the really dynamic trends shaping that ecosystem.
And this isn't just headlines. We've analyzed leading companies across 7 big industry sectors. We're really zeroing in on what happened in late October 2025.
It's about understanding the really fast, kind of volatile changes happening there.
Definitely.
Yeah.
And when you look at the data, I mean, the intensity is just undeniable. We looked at about 50 companies.
Around that, yeah. And it was a period with massive strategic shifts, some really surprising financial volatility, and honestly, some genuine tech breakthroughs.
You really get a snapshot of, well, a system in flux.
And what jumped out from all that analysis? Were there common threads?
Oh, absolutely. Two big overarching themes really stood out. They cut across basically every sector we looked at.
Okay.
First, there's this fundamental shift, architecturally speaking, towards AI integration. It's everywhere.
So AI isn't just like a feature anymore.
No, not at all. It's being built right into the foundations, into the core structure of new products, new systems, from security software to, creative tools, everything.
Okay, that makes sense. And the second theme?
The second one is what you might call market whiplash, or maybe just a huge disconnect.
How so?
You see companies posting really strong operational numbers, hitting targets, executing well, but the stock market, it's often reacting negatively or just flat.
Huh. So doing well operationally doesn't mean the stock goes up.
Exactly. That pronounced disconnect between strong operational performance and negative stock market valuation. It tells us something big has shifted.
Yeah.
The old rules for investment seem, well, different. Investors are demanding something new.
Right. Okay, let's unpack that. Where should we start? Maybe where things were really hot. Cybersecurity.
Yeah, good call. The sources definitely showed cybersecurity is the most active sector. Lots of investment, lots of innovation, especially around AI and quantum resistance.
So who was leading the charge there? Checkpoint.
Checkpoint Software Technologies, yeah. Financially, they had a really impressive Q3, beat the analyst forecasts.
Wow, impressive.
Well, their net profit surged massively, about 70%. Now, I got to say, a big chunk of that was a one-time tax benefit, so you need to factor that in.
Okay, fair enough. But even without that?
Even without that boost, yeah, they still beat projections. Solid revenue growth, around 6.7%. But what's maybe more important is the strategic stuff.
Like launching their AI Cloud Protect solution.
Exactly. And that's powered by NVIDIA Bluefield Technologies.
Which means, for people not deep in the tech,
it means they're using specialized hardware, these things called DPUs, data processing units. Think of it like a second mini-computer inside the server, just handling security and networking stuff.
So security built right into the hardware, not just software layered on top.
Precisely. And their CEO made it clear they're recruiting AI specialists like crazy worldwide to push this. It's a big shift.
Okay, so the big players are adapting fast with AI, but you mentioned smaller companies too, looking at future threats, quantum.
Right. CyberEdge. They unveiled something genuinely different, a photonic-based encryption layer for optical fiber.
Photonics. So using light.
Yeah, basically using light at the physical hardware level to essentially make the data invisible while it's traveling. It's a paradigm shift.
Why is that so important?
Because it offers protection not just against today's threats, but against the kind of decryption power we expect from quantum computers down the line. It's future-proofing the network itself.
Wow. Building for tomorrow's problems. And you can see the interest, right? Their company size grew.
Yeah, the data shows they expanded, went from maybe 110 employees up to the 1150 bracket. That reflects real demand for this kind of forward-looking tech.
Okay, but let's swing back to that market volatility thing you mentioned, Varonis Systems.
Ah, Varonis. Perfect example. They actually met their earnings estimates for the quarter.
So, good news.
You'd think, but their shares plummeted, down a staggering 28.2%.
Just like that. Why? If earnings were okay.
Because they missed on revenue expectations.
Yeah.
Even slightly. And in cybersecurity right now.
It's all about growth.
It really is. Investors seem to see it as a land grab. They want market share expansion above all else. Profitability seems secondary, at least for now.
So missing the revenue target, even if profits are fine, signals you aren't grabbing territory fast enough.
That seems to be the message the market sent. And Varonis' immediate reaction, announcing a $150 million share buyback program to try and show confidence and stabilize the stock.
Wow. Okay. It's a tough crowd out there. The message is clear. Scale fast or get punished.
Pretty much, yeah.
Let's use that idea of strategic maneuvering. Maybe shift gears to segment 2, Physical systems, autonomous solutions. Defense, energy, where AI meets the real world.
Good transition.
Right.
Because you see similar pressures, but different applications. Take climate defense, for instance. Fire Dome,
What did they achieve?
a really significant milestone. The first real-world demo of their autonomous wildfire resilience system.
Autonomous wildfire resilience. How does that work?
They're using AI, predictive algorithms, to actually anticipate where a fire will spread and then deploy resources, maybe create protective barriers proactively, moving beyond just human reaction.
So AI defending against wildfires, that's powerful. And on the more traditional defense side, defend solutions, counter-drone tech.
Yeah, Defend, they're focused on RF cyber-based counter-drone tech. The key thing here is it's not kinetic, meaning it doesn't shoot the drone down, and it's not jamming.
So what does it do?
It allows security forces to essentially take over the unauthorized drone, hack into it, control it, land it safely.
Ah, so you capture it rather than just destroy it, less collateral damage, plus intelligence gathering.
Exactly. You minimize risk, you can analyze the drone afterwards. It's a much more sophisticated approach.
Okay, now clean energy. SolarEdge, they had a big operational win, right? But the market.
Yeah, another case of that disconnect we talked about. Operationally, they hit a huge milestone, surpassed 500 megawatt hours of storage capacity deployed across their virtual power plants.
500 mW, that's substantial. We're like this.
Across 16 U.S. states, plus Canada and Puerto Rico. It really shows they're moving beyond just making solar inverters. They're becoming an energy management platform. They even announced a new collaboration with Texture for grid programs.
So big operational success, expanding capabilities, and the stock
Declined. Despite the positive operational news, it just didn't move the needle for investors, it seems.
That disconnect again, it's baffling sometimes.
It really is. And connecting this to geopolitics, sometimes survival depends on clever strategy. Look at Rafael Advanced Defense Systems.
Israel's big defense contractor, what were they doing?
Facing political constraints, potentially limiting their access to European markets. So what did they do? Forged strategic partnerships with German firms.
Ah, so using partnerships as a kind of workaround to navigate the politics.
Pretty much, it allows them to continue maintaining systems, supplying allies, expanding their presence in Europe, even if the direct political winds are shifting. It's smart maneuvering.
And that need for alliances, for
Yeah.
partnerships, it's not just defense, is it?
Not at all. Which leads us nicely into the next area, the partnership economy. How alliances are driving scale in sectors like health tech and software.
Okay, let's talk partnerships. Health tech first.
Paulson Moore is a great example here.
All right.
They announced a massive expansion of their partnership with Clelit Health Services.
Claylet, that's Israel's biggest healthcare provider, right?
Exactly. And get this. Paulson Moore is deploying 25,000 of their home ultrasound devices
25,000.
for home use.
Yeah, for remote prenatal care. It allows expectant mothers to perform routine scans at home, guided remotely. It's genuinely one of the largest telemedicine initiatives in maternal health anywhere in the world.
That's incredible scale. It enabled it entirely by that partnership.
Absolutely. And then you see strategic repositioning through partnerships in biotech, too. Mastem, for instance.
What was their move?
Kind of a double whammy. They decided to delist from the Tel Aviv Stock Exchange.
Okay.
But pretty much simultaneously, they announced a major partnership, maybe even a merger arrangement, with a Swiss biopharma company, NLS Pharmaceutics. Interesting. So moving off the local exchange, but linking up internationally.
It suggests as a strategic pivot, yeah. Moving away from a local public market maybe to focus resources on international clinical development, possibly tapping into Swiss expertise or funding networks. Makes sense for a biotech looking for global reach.
Right. Partnerships for global scale. And we saw this in software, too. Validating companies. Wix.
Yeah, Wix had a bit of a rough time stock-wise, fell about 20.7%. Market volatility hitting them, too.
But they landed a big partnership.
A very significant one with PayPal for their new agentic commerce solution.
Agentic commerce, what's that? Sounds futuristic.
It kind of is. It refers to AI tools that act like autonomous agents for businesses or consumers. They can handle tasks like finding suppliers, negotiating prices, processing payments, all automatically.
Whoa. So
Okay.
AI doing the buying and selling for you.
That's the idea. And this PayPal partnership puts Wix right at the intersection of, website building and this emerging world of AI-driven commerce. Huge validation.
And JFrog got some major validation too, right?
They did. Named GitHub's Tech Partner of the Year for 2025.
That's a big stamp of approval from a giant in the developer world.
Absolutely. It validates their whole platform for managing the software supply chain, especially important for DevSecOps, integrating security into development, and for all the complex AI development happening now. Secure code, secure components, it's critical.
Okay, so the pattern is clear. Partnerships are key for scale, for validation, for navigating tricky political waters.
Couldn't have said it better.
Right, let's circle back then to that other major theme, the market scrutiny, the disconnect, and how companies are responding internally, segment 4.
Yeah, let's look at that market pressure and the restructuring it's forcing. Fintech is a prime example of the disconnect. Take Payoneer.
What's their story?
Wall Street analysts are actually really bullish on them. Looking at 5 years of strong revenue growth, strategic moves, they projected, get this, a 41.42% upside potential.
Over 41% upside. That's huge, so the stock must be flying.
Nope. Shares were trading down.
Seriously, despite that analyst optimism.
What? Seems to reflect broader headwinds hitting the whole fintech sector. Lingering worries about interest rates, maybe questions about margins. The market just wasn't buying the growth story alone.
So even the strong growth and analyst love isn't enough if the sector's out of favor or margins are questioned.
Exactly. And that intense focus on financial efficiency, on profitability, really hit Monday.com too.
Monday.com, they usually post strong results, don't they?
They did. Reported strong financials again. But the stock still fell.
Why? What's the market demanding from them?
It seems to be operating leverage. It's not enough just to grow revenue anymore, especially in SaaS. Meaning investors want to see that each new dollar of revenue costs less to acquire than the last one. They want proof of efficiency, of scalable profitability, margin expansion, not just top-line growth, the growth at all costs era. It feels definitively over for SaaS.
Okay, so this pressure for efficiency, for profitability, it must be forcing some serious changes inside companies. Lightricks.
Lightricks is a fascinating, if maybe painful, example of this. They are undergoing a major AI-driven reorganization.
How so?
It's quite stark. They laid off 85 employees. But at the same time, they announced they were actively recruiting 30 new specialists focused purely on AI.
Wow. So cutting significantly in some areas to fund a deep investment in AI talent.
That's precisely. It's a clear strategic reorientation. They're betting the company's future on their AI video model and restructuring aggressively to make that happen. It shows AI isn't just a tech upgrade. It demands organizational change.
Trading existing roles for specialized future ones, that's a tough call, but shows commitment. And finally, consolidation. Big players getting bought.
Yeah, we saw signs of that at the top tier, AppsFlyer. They emerged as a potential major acquisition target.
Who's looking at them?
Goldman Sachs is running the process, and reports say it's attracted serious interest from major players, including Fortissimo and the U.S. investment giant Apollo.
That signals the market is maturing, right? These critical mobile infrastructure pieces are becoming prime consolidation targets.
Definitely. It suggests these platforms are seen as established, valuable assets now.
Okay, whew. That was a lot. Let's try and synthesize this for everyone listening.
Yeah.
What are the big takeaways from this snapshot of late October 2025?
I think there are three main things to really focus on. First, AI is the new operational mandate. It's not optional.
And it requires real change, like we saw with Lightricks, not just talk.
Exactly. Organizational restructuring is part of the deal. You can't just sprinkle AI on top.
Okay, takeaway number one, AI means real change. What's number two?
Number two, the market is laser-focused on profitability and sustainable unit economics. Pure growth isn't cutting it anymore.
Right, the Payoneer and Monday.com examples make that painfully clear. Growth needs to come with proven efficiency, with margin improvement.
Yeah, the market wants to see that path to sustainable profit, not just burning cash for users.
Got it. And the third takeaway?
Third, strategic partnerships are absolutely crucial. They're enabling massive scale, like Pulse and more. They're providing validation, like for JFrog. And they're helping navigate complex geopolitics, like Raphael.
So AI mandate, profitability focus, and partnership power. Those are the big three.
I think so. They really capture the dynamics we saw.
You know, there was one company whose stock actually rose significantly, and it perfectly illustrates that profitability point.
Ah, you're thinking of Elsight, the connectivity provider for drones and ground vehicles.
Exactly. Their shares jumped, what was it, nearly 14%?
Around 13.8%, yeah.
Yeah.
And why? Not just because they announced record revenue.
But because they announced record revenue and their first ever quarter of profitability.
That's the key. That single quarter where they proved they could make money, not just grow sales, That seemed to be the inflection point the market was waiting for.
It really crystallizes the shift, doesn't it?
It does. And it leaves us with a really provocative question for you, the listener, to think about. In this current climate, does the market now value that one validated quarter of profitability more highly than, say, 5 years of consistent, strong revenue growth that hasn't yet proven the margin story?
Profitability proof versus growth track record.
Yeah. If that single profitable quarter carries more weight now, what does that mean for the investment strategy of every single company out there still chasing growth above all else? It could change everything.
Definitely something to mull over. Food for thought as you navigate your own strategies.